Hi, good morning, everyone. Hi, good morning, Neetu. Can you hear me?
Yes, I can hear you.
Great. So I think we can start with sharing the screen.
Are you be able to see my screen, my presentation?
Yes, I can see the screen, but I think you'll have to switch to the presentation.
Yeah. My screen is visible to you, Vipul?
Yes, we can. We can see the screen.
Okay.
Great. Great. So let's start in a minute. I can see viewers joining us.
Okay.
Okay, we're good to go. Good afternoon, everyone. Thank you so much for joining in today. This is the third session that we're doing with AKGVG and Associates. Thank you so much, Neetu and Ruchika, for joining in again on a Saturday. And we got a great topic for everyone today. So we're going to be talking about pioneering in compliances. And we have the first speaker, who's Neetu Saini. She is head secretarial department for AKGVG and Associates. So we have multiple viewers. We have people who have logged in directly into VidPhone. We also have viewers on Facebook and LinkedIn who are watching this live. So what we're going to do as a process is that we're going to let Neetu start off with the presentation. And if you have any questions, please send it to me via comments on Facebook and LinkedIn. Similarly, here also you can add it into the comments. We will take it up post Neetu's presentation. That will be for half an hour, and then we will have Ruchika, who will be talking, and who is basically the manager, direct tax. and we'll follow the same format. We will then ask her questions at the end of her presentation. Again, in between, if you have any questions, please leave it in the comment box. I'll pick it up from there. And thank you so much for joining us again today. With that, I will like to hand it over to Neetu Saini. Neetu, thank you so much for taking out the time today. It's a really interesting topic, and we got a great feedback from the one that we did, the last time. So thank you so much again, for taking out the time. And over to you, Neetu.
Thank you, Prabal. Thank you for introduction. Good afternoon, everyone. I'm CS Neetu Saini this side, Secretarial Compliances Head of AKGVG and Associates. So our topic of the day is Pioneer with Compliances Startup. I'm here to discuss what major thing has to be kept in mind during the year to avoid default in companies. I have covered some part only because of the short span of time. So our first topic of the day is MBP1 and DIR 8. Form MBP 1 is that every director of the company in first meeting of the board of directors in each financial year will disclose his interest in another entity. Also, every director is required to submit with the company fresh MBP 1 whenever there is change in his interest from earlier given MBP 1. Now, come to the form DIR 8. Every company of in each financial year will file with the company disclosure of known disqualification. Now, the question arises is that what if the director fails to file MBB1 with the company or contravenes the provision? Then such director shall be punishable with imprisonment for a term which may extend to 1 year or with fine which may extend to 1 lakh or with both. We have seen that every director has their own format for MBP1 and DIR8. But the Companies Act 2013 has specified the prescribed format for MBP1 and DIR8. But the company, so in my next slide, you will see the format for both the form prescribed by the Act. As in the first box, we can see the format of form MBP1. In this, the detail of director and the name of the company, position, and shareholding of the director, other entities is to be disclosed. And in next box, the format of GIR rate is specified. In this the details of company, registration number, nominal capital, paid up capital, name of the company, and his director will be specified. In DIR 8, the director will disclose the name of the company and the position held by him and her during the last 3 years. The second topic is stamp duty on share certificate. Applicability of stamp duty arises at the time of issue of share certificate. The company must ensure the required stamp duty is paid before the issuance of share certificate to the shareholder. The share certificates are not valid unless the stamp duty is paid on the same and the certificate carries the stamps or the reference to payment of stamp duty. The stamp duty is to be paid as per the rate prescribed under the respective stamp duty of the state where the registered office of the company is situated. In this slide, we have specified the rate of the stamp duty of same of state union territories. As in all state union territories, the rates are specified by their respective stamp acts. For example, in Delhi, the rate of stamp duty is 1 rupee for every 1000 or a part therefore of the value of the shares, including the amount of premium, if any. In Karnataka, it is rupee 1 for every 1000 or a part thereof of the value of the share including the amount of premium. In Haryana, it is rupee 1 for every 1000 or a part thereof of the value of the share including the amount of premium, if any. Same as in Rajasthan, it is rupee 1 for every 1000 or a part thereof of the value of the share, including of premium, if any. Every time we have to take care of the premium amount also while calculating stamp duty on share certificate. The third topic is annual journal meeting. Annual journal meeting is a meeting conducted by every private company or limited company that provides an opportunity to the shareholders to meet every year and discuss matter related to the company. The AGM ensures the interest of the shareholder is protected. Now we will come to the tenure of the AGM. At what time we have to conduct the AGM? First annual general meeting of the company must be held within 18 months from the date of incorporation of company. The subsequent AGM must be held 15 months from the date of last annual general meeting or 6 months from closure of the financial year, that is September 30th of every year, whichever is earlier. The MCA has extended date of AGM due to COVID, which is of the 3 months. The company whose financial year ends on 31st March 2020 could hold AGM by 31st December 2020 as against the regular date of conducting AGM, which is 30th September, without filing GNL 1. As we are discussing about annual general meeting, then let's have detailed discussion about the AGM extension also. As per Section 96 of Subsection 1 of the Companies Act 2013, the registrar may, for any special reason, extend the time within which any general meeting other than the first annual general meeting shall be held by a period exceeding 3 months. Companies Act has specified the procedure of AGM extension and what's that process. Let's have an overview. First step is to call board meeting as per 173 of the Companies Act 2013 and Secretarial Standard 1 to discuss reason for not holding AGM on time, and in this said meeting pass resolution for filing application to the ROC for seeking extension of time for holding AGM and authorize any director, company secretary to sign such application. Then draft the application with specific reason and file E-Form GNL 1 pursuant to Rule 12 Sub-Rule of the Company's Registration Fees and Fees Rules 2014 and attach certified true copy of board resolution along with the application. Now, what if the company has not followed the prescribed process or contravened the provision? Then company and every officer of the company who is in default shall be punishable with fine which may extend to rupees 1 lakh, and in case of continuing default with a further fine which may extend to rupees 5,000 for every day during which such default continues. Now, heading towards the next topic, board meeting.
Neetu, if I can just pause you there for a second. So we've got a few questions from the viewers. Everyone who's on the VidPhone platform, if you want to see the presentation clearly, please click on the video. So that is Neetu's video. So that will expand for you. Everybody else who's on LinkedIn and Facebook, guys, we will also be sharing the presentation post the webinar. So please don't worry about it. You will have the information at your disposal. Sorry to interrupt, Neetu. Please go ahead.
Next, heading towards to the next topic, board meeting. Every company shall hold its first board meeting within 30 days from the date of incorporation. After the board meeting, every company shall hold minimum 4 board meetings every year, and in holding board meetings during the year, there shall not be more than 120 days gap between two consecutive board meetings. Before conducting the board meeting, the notice of board meeting will be delivered. Every board meeting shall be held by giving at least 7 days notice in writing to every director at his address registered with the company, and such notice shall be sent by hand delivery or by post or by electronic means. The quorum for meeting a board of directors of a company shall be one third of the total strength or two director, whichever is higher, and the participation through video conferencing or audio visual means shall be counted for the purpose of quorum. But in the view of current pandemic situation caused by COVID-19, MCA has further relaxed the requirement of holding board meeting with physical presence of directors in respect of the following matters: approval of the board uh, for annual financial statement, approval of the board report, approval of the prospectus, approval of the matter related to amalgamation, merger, demerger, acquisition, and takeover. Now, these businesses can be transacted in board meeting held through video conferencing or through any audio visual means by duly ensuring compliance of Rule 3 of the Companies Meeting of Board and its Power Rule 2014 till 30th December 2020. Earlier, MC has relaxation till 30th September 2020. Now, our next topic is MSME Form. In exercise of power confirmed by Section 9 of the MSME Act 2006, the Ministry of MSME had via notification dated 2nd of November 2018 directed that the half-yearly return is required to be submitted to the Ministry of Corporate Affairs on a mandatory basis by all those companies who receive the supply of goods or services from micro or small enterprises, and the payment done to these micro and small enterprises suppliers exceed 45 days from the date of acceptance or deemed acceptance of the relevant goods and services. The following points must be stated in it. First is the amount of payment due and the reason of the delay. Let's come to the penalty part. And the penalties for default will be the company or every officer of the company who is in default shall be liable to a penalty of 25,000, or in case of continuing failure with a failure, further penalty of 1,000 for each day or after during which such failure continues, subject to maximum of 3 lakh rupees. And finally, that brings us to the end of the presentation about the pioneer with compliances startup, and now heading towards the question and answer round.
So thank you so much for that, Neil. We have three questions as of now. So the first one is by anonymous. So they ask, how can I convert my LLP into a private limited?
LLP can be converted into a private limited. It's a lengthy procedure, but easy to convert. We can discuss or we can share the checklist. What documents will we be requiring for conversion? We can share on his email ID. If he can share.
Mhm.
Any other question related to the LLP to private limited, I can hear and I can discuss here.
Got it. So, anonymous user, you can actually write an email at info@akgvg.com and probably discuss it internally. So, should be able to help you clarify. The second question that we have is from Aditya from Clairviz. He asked, "Are there any specific protocols for annual general meeting if your investors are not in India?"
Yes, in the pandemic situation, AGM can be held through video conferencing or any other audio means. Then they can participate through that video conferencing in abroad also. They can raise queries, they can pass resolution, they can against the resolution also.
Hmm.
But it is allowed in COVID situation only. As per the Act, as per the Companies Act 2013, AGM can be held in India and they have to attend in India only. But in pandemic situation, they can join through video conferencing, or they can request to the company held AGM through video conferencing or other visual means.
Great, got it. So I hope that clarifies your doubt. The other question again is anonymous. The question is, can a co-founder with 60% equity make a business decision like partnering with a new organization or getting an investor on board? So I guess he means that, if he has 60% equity, can he override or, make a decision, for the other 40% as well?
Yes, he cannot override. 60% doesn't mean that he holds the entire power of the board or other decisions, because most of the resolution, important resolutions, shall be passed by 75% majority of the shareholder, and he holding 60% only. And if he holds 75%, more than 75%, then he cannot override the other shareholder, because minority shareholder interest is also here. Act having provision about the minority shareholder also. He can he can give the views or their point of views in the shareholder meeting, but every time he cannot override the rights of other shareholders or cannot take the decisions.
Got it. So regardless of what percentage he has, if he has another co-founder, that co-founder needs, or those multiple founders need to come together to make a business decision.
Correct. Minority shareholder interest is here, provisions are here, so he cannot override every time.
Got it. Are there any cases where this is possible, where they can override with the majority stake or equity?
No, I don't think there is provision, because if anybody overrides by forgery or otherwise, then minority shareholder have a right to file a application to NCLT. Then through NCLT, he can prove every time I have the overrided. So we have to be very careful, so that every time you have to take the permission of other minority shareholder also.
Got it. Got it. Great. So that really helps. Neetu, that's all the questions that I've got for now. Anybody who else has more questions, please write in at info@akgvg.com. You should be able to get your answers there. Great. Thank you, Neetu, so much. Thank you for taking out the time and sharing this valuable information. Thank you.
Thank you, sir. Thank you.
I would like to introduce Ruchika Gupta now. She is the second speaker for today. Hi, Ruchika. Thank you so much for taking out the time. So we'll be able to take it from there, and we'll follow the same format. Ruchika will present, and post that we'll be able to take questions. In the meantime, please post your questions on the comment section on your platform, and I'll grab it from there and share it with the speaker. Ruchika, once again, thank you so much for taking out the time. And if you're set, we're ready to go.
Yeah, very good afternoon to everyone. Ruchika this side from AKG on behalf of AKGVG. Here we are joined today to talk about a very interesting topic, which is very recent and very much common nowadays. That is how to file income tax returns. So this is quite the buzz nowadays, because the return filing season is just around the corner, and everyone is just going here and then just worrying how should we complete our filing. So today my focus will be totally around the corporate income tax return, which is ITR 6. And considering the time involved, we are focusing on the major common errors that everyone does while filing the corporate income tax returns. So I have jotted down the things in couple of slides by compiling them in different segments one by one. And so we can start with mismatch in information reported in different schedules of ITS. So the ITR 6 in total is a 59-pager form consisting of n number of schedules. So while filing the ITR, everyone is just worried whether we should just disclose the income details and just go on and file the return, and still they are always worried that whether we'll receive notices or not. And even after taking all due cautions, we do receive notices. So just to avoid such things, we just need to ensure a couple of things, just like this, that for example, there is a schedule named BP providing business income, and there is a schedule named Part A OI which provides the other information. The Part A OI other information schedule provides the tax audit report details, and BP schedule computes the business income. So business income is computed based on the information reported under the tax audit report. Accordingly, both the schedules should be providing the same information, and the allowances and disallowances appearing in both the segments should tally. If in case there is a disallowance as per tax audit report, which is reported in Part A OI, but it is missed in Part BP, in that case, you'll get a notice as you have not disclosed your allowance disallowance perfectly. And to avoid such things, we should always tally what we have disclosed in Part Schedule BP as well as Part A OI. So this way, we will not receive any such discrepancy notices. Similarly, another important thing is about reclassification of income. For example, if in our balance sheet there is some interest income, if that interest income is not directly related to our business, for example, we have some spare money and we have just made an FD, and that FD, through that FD, we are generating some interest income. So that interest income should not be reported under your PGBP, that is profit from business head. Rather, it should be disclosed in other sources head. So that's why sometimes what will happen in the schedule BP, we reduce it from the business income, but while filling schedule OS, we forget to add that interest income in the OS schedule. Due to this, the income tax authorities do notice this error, that some income has been reduced in the business income but has not been added in the OS, due to which your income will be reduced and you'll get a notice with the demand in hand. Next, we move on to the mismatch in information reported in ITR and tax audit reports. This is very, very crucial. So there are a number of tax audit reports or the tax certificates which the CAs issue, and we need to ensure that all the information that the CAs have issued in the certificates or tax audit reports, we need to ensure that those are correctly fed in your income tax return. So first of all, you need to ensure that all the allowances and disallowances in the tax audit report should be reported in the ITR. So what does that mean? That, for example, there is a ATG, there is an expense related to interest on TDS. So some tax auditors report it under section 48.2 and some tax auditors report it under section 37. On the other hand, if the tax auditor has reported it in under section 37 and you are reporting it under section 48.2, then what happened? There will be a mismatch. So that's why it is very important that whichever way the allowance or disallowance has been reported in the tax audit report, it should be reported the same way in the ITR as well. Similarly, it goes for transfer pricing certificate, as the transfer pricing certificate provides all the details of international transaction with the group entities. So, and in the income tax return form, there is a specific schedule named FD providing details of all the foreign transactions undertaken by the company. So when you are disclosing in your form 3 CEB, that is the transfer pricing certificate, that you have undertaken 1 crore transaction, a transaction of amounting to 1 crore with your related entities, then that amount should be reported in FD schedule as well. Because in that case, if you are not reporting it, then income tax department already knows that you have reported this information in the transfer pricing certificate, and that's why there's a non-disclosure in your ITR and you are bound to get a notice. Similarly, it goes for Form 29B, which is filed for MAT. So whenever MAT gets applicable on a company, it is required for the company to get the certificate from the CA in Form 29B. This Form 29B is also uploaded on the income filing e-filing portal, and the calculation appearing in this Form 29B should be reported in the max schedule in your ITR form. If you don't do that, there will be a mismatch, and obviously you are bound to receive a notice. Given this, you can see that whatever kind of certificate you get from your CA, whether it's a transfer pricing certificate, tax audit report, or MAT certificate, you need to ensure that all are correctly reported and matched while filling your ITR form. Next, we move on to the non-reconciliation of ITR with Form 26S. This is a very, very important and very crucial aspect nowadays, because recently the Income Tax Department has expanded the scope of Form 26S and have included so many other things other than just the TDS that is deducted out of your income. So what earlier used to be that whatever transactions on whatever income that you're receiving on which tax is required to be deducted, the deductor deducts it, and the income along with the TDS appears in your Form 26S. But now the Form 26S also provides your GST turnover every month, every quarter. Whenever you file your GST returns, the details get uploaded and updated in your Form 26S. Similarly, it goes for the SFT transaction. So if you purchase any movable property, sell any movable property, it will appear in your Form 26S. So you can't hide those details. If you're selling a property, you should disclose it in your ITR. Otherwise, government authorities already know that you have what kind of transactions you have done, and if you miss that, they are bound to issue notices along with concealment penalties. So as you can see, any receipt appearing in Form 26 should be offered to tax in ITR. Otherwise, you will receive an income tax notice for the same. So you can just note that whatever kind of transactions are there in your 26AS, these are somehow accounted for in your income tax return. For example, if there is an interest income from a bank account, like from an FD, then that should be appearing in your OS schedule, that is schedule OS of other sources. If there is a business receipt, like a profession receipt or a contract receipt on which TDS has been deducted under section 194C or J, then that should be appearing in your PGBP schedule, which is BP schedule. So everything should tally. The 26 years details should tally with your ITR. Similarly, the TDS and TCS claim should be strictly as per Form 26 years. Any excess TDS which you know has been deducted by the payer but is not appearing in your Form 26 years, you should ask your payer to file the TDS return. That is the only reason why it is not appearing in your 26 years. Once that person puts it in the TDS return, it will automatically get disclosed in your Form 26 years. Otherwise, you will not get that credit. But till the time that deductor is not filing its TDS return, you can definitely claim it in your income tax return. You might get a notice, but you can ask for reprocessing and it will get sorted out. However, if there is any TDS which is not pertaining to current year income, should be carried forward to next year. So for example, if in case you are for the year ending March 2020, you are booking some income on accrual basis. However, that party is expensing off in its books of accounts in the year 2021. In that case, its income will not be appearing in your 26 years. However, there can be a reverse case as well, wherein you are not accruing the income, but the same is you are not accruing the income in your books of accounts. However, the deductor has deducted tax by accruing the expense in its books of accounts. In such case, that income will be appearing in your 26 years, despite the fact that it is not your income for the current year. So in that case, the ITR form provides an option so that you can just carry forward this TDS to the next year when your income will be appearing in the income tax return, and it will tally with the TDS which you have been deducted. Next is the head of income under with the receipt on which TDS has been deducted and should be reported in the scheduled TDS. So there is earlier what used to happen was whatever was appearing in 26 years, used to get automatically allowed. But now, to get a claim of TDS appearing in Form 26AS, what you need to do is, in the scheduled TDS in your ITR form, you need to disclose all the Form 26AS details. Along with that, you need to report as to this TDS reports to which this TDS is related to which kind of income, and that income you have reported in which head of income. So, for example, there is an interest income, whether the same has been appearing in Form BP, in Schedule BP or Schedule OS. They don't know. The income tax department doesn't know. They want to tally that. So if there is no income in other sources, but in the TDS schedule you write it OS, then definitely you'll get a notice that when there is no income reported in OS, then how can you claim the TDS on that? So this is the reason why we need to match the 26 years receipt with your sources of income and disclose it appropriately in your schedules as well as the TDS schedule. Similarly goes with the GST reconciliation. As I've already mentioned that GST turnover is appearing in the in your 26 years. Similarly, in the form in your ITR form, you need to provide the details of the GST turnover as per your GST returns. Now, in the ITR form, you are disclosing both the details: the turnover as per your books of account, turnover as per GST, and if there is not, they are not in reconciliation, that means the department knows that you are somewhere hiding some facts, or there may be case of genuine reasons for this non-reconciliation. So in such cases, you need to prepare a reconciliation and keep the same with yourself, so that in case the department ever asks you for any clarification or requests any details as to why there's a difference, and you get a notice on that, so you can apply the same on. The next, we move on to the non-completion of all schedules of ITR. As I mentioned earlier, that the income tax return form for companies, which is ITR 6, is a 59-pager forms with numerous n number of schedules. It happens that sometimes the assessees miss some schedules, considering that these are not mandatory, so we should not just fill them. We should just fill those schedules due to which there is some error. But by leaving those other schedules blank, you are missing important information, due to which you may get notices. How? You may see now. The companies must disclose details of all directors who held office at any time during the year. So as you are aware that directors' details are readily available on the MCA, so all the DIN numbers are linked with their PAN numbers, and the PAN numbers and DIN numbers are linked to the company's PAN number. So if a company is not disclosing all details of all the directors who held at the office at any time during the year, then obviously this information is already there with the MCA, and they can definitely check and cross-check that with the income tax return of the directors as well, because these directors need to report the name of the company in which this person is director in their own personal income tax return, that is ITR 1, 2, 3, or 4. So that way, whenever there is a mismatch between two different ITRs, because everything is linked with the PAN of the company and PAN of the director, then obviously again there is a high chance that you'll get a notice that why you're not reporting the information correctly in your income tax return. Similarly goes with the details of beneficial shareholders holding at least 10% stake at any time during the year. So there are two schedules in ITR form. One is schedule SH1, which provides details of shares issued by the company. One is that, for example, there is a company ABC who's having shares, whose shares are held by A, B, and C. Now, what matters in the income tax return is not just the shareholder, which is reported in Schedule SH1, but it also matters that who is a beneficial shareholder of the company. So, for example, the company A, company B, and company C, they are in turn held by company X, company Y, and company Z. In that case, the beneficial holders of the company ABC will not be A, B, or C, but they will be X, Y, and Z. And that's why beneficial shareholder details is required to be mandatorily reported here. This information is also cross-tallied with the individual ITRs of these shareholders, where they are bound to report how many shares you are holding of any private limited company, and this information also gets cross-checked between the individual ITRs and the corporate ITRs, just similar to the information of directors as we talked just before this. The next comes the details of natural persons who are holding at least 10% stake. In my example, wherein in the company ABC Limited, in ABC Private Limited, there are three shareholders, A, B, and company A, company B, and company C. And these three companies are in turn held by company X, Y, and company Z. In that case, it is not just that the disclosure of beneficial shareholding just not ends at company X, company Y, or company Z. You need to go back and see who is the natural person who's owning shares in company ABC, whether it is the shareholder of company X or the shareholder of the company X shareholder. So this direct or indirect shareholding goes on forever, and you need to check the ultimate natural person who is holding stake in the company, which is more than 10%, and report the details of that person in this ITR form. The next goes for the asset liability schedules. So people report all the details in the balance sheet schedule in ITR, but they forget to report information in the AL1 schedule, which was introduced last year itself. In the schedule, you need to report all kinds of assets and liabilities other than your stocks and debtors and creditors. If you're not reporting them correctly, for example, you need to report your motor cars, your bikes, all your vehicles, all your stock in trade if it is related to your some property, some immovable property, or some jewelry. Even if your stock is in these form, you need to report the same, and you need to mention that this is held as stock in trade. And in case you don't report and in some future year you are selling it, then the income tax department already knows that when you were not holding these assets in earlier years, how are you selling them? Then definitely you'll get a notice that you were not disclosing this information correctly in your earlier years ITR. Then next comes the bank accounts. Generally what happens is that people tend to forget how many bank accounts there are. So in corporates, obviously that does not matter so much, because when the books are finalized, all the accounts are matched. However, in the case of individuals do forget to record or report income of one bank account which is not their very active bank account. So what happens, for example, I have a bank account, I have opened my bank account in 4 different banks. One is my primary account. I report information about that, and I just forget to report income about my saving bank account in some other bank. So that should not happen, because that income is also taxable, and department will definitely get back to you, because they know your PAN number through the bank account, and the bank account is already reporting those information about the income earned by you to the income tax department in a different form, which is AIR, etc. Similarly, it goes for the exempt income. For example, some companies think that yes, dividend is an exempt income, then why should we report it? It is not taxable. But no, that is not how you should do. You need to report your exempt income as well, because that's a mandatory disclosure for all the corporates as well as individuals, so that you can't say that you have not reported any income. If whatever income is exempt, you just report it and report the section in which this income is exempt. Then next we move on to the filing ITR before filing audit reports. This is rare, but yes, such kind of errors do happen. So there are certain forms which needs to be filed even before filing the ITR. So you need to ensure that these forms are filed before uploading the ITR. So we first talk about the form 10 IB, IC, and ID, which you must be aware are mandatory in case you want to claim benefit of the reduced rate of corporate tax under section 115BA, 115BAA, and 115BAB. If a company wants to claim benefit under these sections, they need to first fill and file Form 10IB, 10IC, and 10ID. If they don't file those forms, they will not be eligible to claim benefit of these sections. Similarly goes for all tax audit reports, CA certificates. These all should be filed well before the ITR, and the details of these audit reports, these certificates should be reported correctly in your ITR, reporting as to when these forms were filed, under what section they were filed, and how they were filed, and only then you should file your ITR. Unless and until all audit reports have been furnished before filing of ITR, benefit of such a report is not available in the ITR, and you'll get a notice that you have not filed this audit report, which was mandatory in your case. And again, you have to keep on filing the returns, the revised returns, and respond to all such notices which were avoidable. So this is the way how you can see that such petty things which we just miss out, if we just take care of the same, we can save a lot of time and energy by not receiving those notices which are generally issued to all corporates. That's all from today. You're free to ask any questions that you might be having.
Thank you so much, Ruchika. That was really, really insightful. I have been bombarded with questions, but for the paucity of time, I've selected the first ones that have come, and also to keep the identity anonymous. I'm not mentioning some of the names. So the first question is again by anonymous. Do unprofitable startups need to file a tax return?
Yes. So, as per the income tax provisions, any company means any company which is registered under the Companies Act need to file its income tax return before the due date of filing the return. If they are not filing the return, there will be a penalty for late filing of 1,000 minimum if you are not having any income, and in case you are having an income, then it may raise to 10,000 rupees.
Got
So
it.
for unprofitable companies also, you need to file your ITR.
You need to file your idea. Then the second question we have is from Sarita from Coach Buddy. She asks, my company is still in early stage. Will this year's tax return ever be important for my business in the future?
Yes, definitely. So filing ITR is like a compliance through which you disclose to the income tax department that whatever business you are doing, you're not hiding anything. You're disclosing whatever you're doing, and it comes as an evidence that whatever you are doing is correct and you're not doing anything wrong. And in future years, obviously, your valuation will depend on your ITRs, that what kind of income, what kind of business you handled. And even if you go to any banker for any kind of loan or any kind of grant, definitely they are going to ask your income tax return, because they appear to be a tax document, a tax certificate issued by the income tax department as a proof that you have such kind of income or assets. So that's why it's very important.
Great. I think that's useful. This seems like a follow up question to the earlier one. It says, if I raise a Series B or a Series C round down the line, will investors want to see tax returns from my company's seed stage?
Yeah, definitely. So investors, while coming to the while investing in any corporate, they would like to know their financials. They would like to see how much potential the company is having, whether they are into losses or not. Definitely, the income tax return provide the actual data, and it acts as a proof that yes, whatever income or assets that the company is having, it exists in certain, and we are not having any fraudulent activities.
So it actually goes back from a compliance point of view also. So as soon as you have a startup, filing your income tax becomes critical, and critical in the sense it becomes like a mandate. You have to follow that
Right.
process.
Right.
So we have another question by Hemnath from Imaginate. He says, do I really need to hire someone to prepare and file a return for my early stage startup? Can I do it on my own?
So, yes, you can do it on your own, but as I mentioned, it's a 59 pager form. So
Wow.
there is a chance that you might miss some information, as I mentioned in my earlier slides, wherein I mentioned that different schedule, different informations, there are more than 60, 70 schedules which need to be prepared. And it would be better if someone with an experience does it. So if any person who has already done some corporate ITR before, if that can fill it again, that's fine. But if someone who is not aware about how the ITR form proceeds, it's better you take some professional advice.
Great. So I think this again question is on the similar lines. So it's by anonymous. So they ask, how much will it cost to fix a messed up return or handle the problem later if I don't file right now?
It can be very, 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 very difficult. So I have just received a query yesterday itself from one of our clients who didn't file its return last year, and the last date for filing this return is 30th November. So for financial year 18-19, who missed its filing its return, the last date is 30th November. If he doesn't file it in the next couple of days, what will happen that he will not be able to file it, and later on the income tax department will come back to you asking that why you have not filed your income tax return, and will levy n number of penalties along with the professional charges which you will be required to pay to a CA for representing you before the income tax authorities, plus the penalties, plus the harassment that you will be facing while discussing everything, while getting all the notices, while responding to all the notices to the department. So the paperwork that will happen at that time would be quite many folds as compared to what time it will take to file the return in time.
Got it. No, that's really interesting because while even in the last session that we had pointed out that the last date is 30th of November. Now the challenge is today is Saturday, today is 28th, then 29th is Sunday. So that leaves people with just like a day. Is there anything
But
that they can
but
do?
yeah, Vipul, that is what I'm trying to say. That earlier the due date for filing returns was 30th November, but because of COVID, this due date has been extended. So for corporates, for financial year 1920, the due date of filing ITRs is 31st January 2020.
Great.
That's why you do have 2 more months to prepare and complete your backlog. But for financial year 18-19, you just have 2 more days to go. So do file your returns in time, otherwise you'll be bombarded with all kinds of notices and the problems which can be avoided if you do it in time.
Great. So I hope our viewers are actually making a note of this. This is critical information. The other question that I have is from Rahul from Flat. So he says, does my startup need to create a K1S?
I would have to check on that K1S. You can just drop in us email and we'll just check on that as to whether it will be applicable to you or not specifically.
Got it. So Rahul, please write into info@akgvg.com, to take this up query directly. The last question that I have is, as a seed stage startup company, what are my chances of being audited?
Can you just come again, Vipul?
So the last question is that as a seed stage company, what
Okay.
are my chances of being audited?
Audited, as per the Income Tax Act, there can be two types of audit. I am not sure about the query. So first can be the tax audit. For tax audit, the minimum threshold is 1 crore. So if your turnover is exceeding 1 crore, then obviously you are not required to get a tax audit. However, there is a stat audit which is mandatory for all companies. So you need to have a stat audit despite the fact whether you are a seed stage company, a new company which has incorporated just now or not, and you need to file your return post completing your stat audit. The next thing is that one is stat audit, one is tax audit. Then after that, if you're not completing then these compliances, then the income tax department do conduct an audit and they may issue notices to you that you are not complying with the compliances which are applicable on you. So that's why you should never miss on any compliance, whether you're a new company or 10 years old company or whichever way, because filing income tax return is mandatory for all, irrespective of the fact whether you are having an income or not. And it does not cost much.
Great, that's really useful, Ruchika. So that's all I have as of now from the questions point of view. Please, all those questions that have not been answered, write in directly, to Ruchika and Neetu, and the email ID is info@akgvg.com. Again, I'm sure you have a lot of questions that you might not want to discuss on an open forum, so you can reach out directly. Ruchika, thank you so much again for taking out the time on a Saturday and sharing all that information with us. So thank you once again. Thank you, Neetu, as well. For taking out her time as well today. And thank you, AKGVG and Associates, to help out with these sessions. On a monthly basis. Where we can reach out and share more informations. So for all the viewers, we'll be sending out emails after this as well with the details from the presentation, and you can continue following our sessions next month as well. We'll do share the timelines with you. Thank you everyone for tuning in and for all the questions. Thank you AKGVG and team. Thank you so much.
Thank you, everybody. Bye bye. Have a great weekend.
Thank you.